Bismillahirrahmanirrahim. Subject is corporate finance and today's topic is preferred stock. Today lecture we will discuss preferred stock features, cumulative dividend features, participating features, voting right in special circumstances, retirement of preferred stock, use of preferred stock in financing, and value of call privilege. What is preferred stock? What is preferred stock is indicated by its name that these are preferred stock which will be given preference by the issuer. Preference over whom? Preference over a common stock shareholder. But preference in what? In dividend, in paying dividend and claim on the asset. So if whenever the company issue us dividend, it will give preference to preferred stockholder. First they will give them dividend to the preferred stockholder, then they are free to give dividend to a common stockholder. So a preferred stock is a type of stock that promises by whom? By corporation, a fixed dividend. Why fixed dividend? It is mentioned on the face of the certificate of preferred stock that this one share is, let's suppose, of rupee 50, 7%. 7% means we will give them 7% dividend per year. And then there are certain other terms and conditions. We will discuss it one by one, but at the discretion of the board of directors. So the board of directors have ultimate authority to declare a dividend or not. Basic terms. What is par value? This par value is basically value that are mentioned at the face of the certificate. Let's suppose it is preferred dividend of 70 rupees. Then this is par value. It have nothing got to do with the market value. This value is called par value and it is registered in the book of the company. So par value never change of any assets. It means that is the assets are issued, that is the value that are recorded in the book of and memorandum and article of association. Second thing which are declared in the preferred stock face value is basically dividend rate. If there is declared that the company is liable to pay 9% dividend, it means the company will pay them exactly of 9%. The company cannot declare a dividend for preferred stock more than 9% or less than 9%. Maturity. Sometimes these preferred stock are for certain time, or sometime it is for it have infinite lifetime. Sometime it have, let's suppose, 20 years, and after 20 years it will mature and the company will be liable to pay this face value to these preferred stockholder and buy back their own certificate. Sometimes there is no callable option, means the dividend have no such time period in which the company is liable to buy it. So the preferred stockholder will hold them forever. But these preferred stock have a secondary market and these shareholder can sell them over there on the organized stock exchanges. Cumulative dividend features. Dividend, if not declared in 1 year, will cumulate with the dividend of the other with the coming year. For example, if it is we have a 100 rupees preferred stock per, this is, let's suppose, price of one preferred stock, and it is, let's suppose, 9% dividend is mentioned in the face of this preferred stock. This is basically rate of dividend, that 9%, the company will be liable to pay them a 9%. This is first year, this is second year. In first year, the company will pay 9 rupees to this on this certificate to this shareholder. If the company is unable to pay it here, they will pay 18 rupees, 9 plus 9, 9 of previous year and 9 of this year. So 9 plus 9. In third year, if company is unable to pay the dividend here, in third year, the company will pay 9, 9 and 9. They will be accumulate over the year, but company is not allowed to delay the paying of dividend after 3 years. So the company will pay 27 in 27 rupees after 3 years. If there is non-cumulative features, then this year dividend is not paid, it will not cumulate. This will not accumulate. In third year, if the company is able to pay, they will only pay a 9 rupees in a non-cumulative dividend feature. Cumulative dividend feature a requirement that all cumulative unpaid dividend on preferred stock be paid before a dividend may be paid on common stock. So if this third year the company is going to pay to the common stock, they will first pay all the amount outstanding that have been accumulated over the year to the preferred stockholder. This is an example. For example, the board of directors omit $6 preferred dividend for 2 years. Means one if it must pay preferred shareholder $12 per share before any dividend can be paid to the common shareholder. Since 6 this previous year and 6 of this year, total $6 of previous year, $6 of this year, total $12. This $12 will be paid to the preferred shareholder if the company have any intention to pay a dividend to the common shareholder or declare a dividend to the common shareholder. The corporation does not have to make up a dividend even if it is profitable, as long as the firm has no plan to pay a dividend to a common shareholder. It is not valid in certain countries. Every country have their own laws. In some country, it is mandatory for the company to pay or not delay the preferred dividend over a 3 year. Here, in United States, the company is not liable to pay any single dividend to a preferred dividend unless and until they declare a dividend to the common shareholder. That is not the case in all scenario or in all country. Participating features. This is another feature. It is not participating in management, participating in shareholder. In dividend. Participating means, let's suppose the company declares 7 rupees for preferred dividend and let's suppose 8 rupees to a common shareholder dividend. If there is any clause in a participating dividend that after 8 each rupees given to the common shareholder will be participated by the preferred shareholder. For example, if the company paid 10 rupees dividend to the common shareholder, 2 rupees will be participated. One will be for preferred shareholder and one will be for common shareholder if it is above the stipulated amount. So preferred stock where the holder is allowed to participate in increasing dividend if the common shareholder receive increasing dividend. So this increasing dividend or extra dividend that are given to common shareholder will also be shared with the preferred shareholder as well. Preferred stockholder have a prior claim on income that we discuss, and opportunity for additional return if there is any additional return if the dividend to the common shareholder exceeds certain amount. This certain amount is basically declared in when issuing a preferred share. This certain amount have been are being finalized with these of the preferred shareholder. Let's suppose a 6% participating preferred issues. 6% means that 100 par value is one certificate. One certificate have 100 rupees par value. Allows holder to share equally in any dividend in excess of 6. If this is participating and we are giving more than $6 to any common shareholder, then extra amount will be shared with the preferred shareholder. For example, a $7 common dividend result in extra 1 dividend to the participating preferred shareholder. So if the company pays $7 to the common stockholder as a dividend, but it should not be more than a 6. That is, let's suppose means $6 is basically a preferred stock dividend. More than this, if paid to the common shareholder, let's suppose if they are paid $8, if they are paid $7, if they are paid $9, these extra amount will be shared with the preferred stockholder if these are given to a common stockholder as a dividend. But below this, nothing will be shared with the preferred stockholder. Voting right in special circumstances. Preferred stockholders are not normally given any voting right or voice in a management or say in a management unless the company is unable to pay preferred stock dividend during a specified period of time. Let's suppose there is 5 years the company was unable to pay dividend 1, 2, 3, 4 and 5. So in 5 years the company was unable to pay dividend to preferred stockholder. Now in this case, the preferred stock, in such circumstances, the preferred stockholder are allowed to elect their specified number of directors. So in such situation, if there is occurred in such circumstances, the class of preferred stockholder would be entitled to elect specified number of directors. Secondly, in any situation or circumstances in which the company default under restrictions in the agreement may lead to voting power for the preferred stockholder. If there is any terms and condition between preferred stockholder and company, let's suppose A Limited. A Limited. And or any instruction on this A Limited in terms of condition from preferred shareholder on this A Limited, and the company breach any of the TOR of this certificate terms of reference or agreement, then the preferred stockholder will elect their own director and exercise their voting power. Preferred stockholder cannot force immediate repayment of obligation like debt obligation. So the preferred stockholder have no power, just like a debt certificate holder, that they can exercise any power that the company should pay immediately their dividend. They will have to wait like other common stockholder. Retirement of preferred stock. By retirement we mean, as we discuss in this long-term debt, it means the company, let's suppose, issued a share of 100 rupees that is preferred shares, and it carry 9% or 10% dividend for, let's suppose, how much long, that is 15 years. Now after 15 year, till 15 year, the company is liable to pay 9% to the preferred stockholder. That is because of this amount. But after 15 year, the company is liable to pay them this par value and get back its preferred stock certificate. So it is called retirement, but huge amount is impossible for the company to pay it one installment. So there are many methods that how to retire or how to buy back or how to pay the par value to the preferred stockholder by the company. So retirement of preferred stockholder, we will discuss it. Call provisions. Almost all issue carry a call provision. Call means that the company can announce to buy back their share at any time because of infinite maturity. These preferred stock have infinite maturity. If there is no 15 years, then infinite maturity. So there will be a call option or call provision in the terms and conditions that the company have a right that any time they can call back their preferred stock and pay them the par value to these shareholder. It is often cheaper method of retirement than open market purchases, because it is possible that in open market the share price or the preferred stock is trading a bit on better higher prices, so it will be difficult for the company to buy it from the open market because of trading. So this method is cheaper if the company put a terms in their preferred stock certificate that the company have a right to buy or to call back at any time and par value. Second methodology is sinking fund. Sinking fund have been discussed in bond. Like bond, many preferred issues provide this method of retirement. What is sinking fund? There is a periodic payment. Periodic payment. Periodic payment by the issuer or by the corporations in order to buy back their shares, preferred stock. So how they will do that? Even may they give a serial number in a lucky draw that this number will be buy back in this, let's suppose in a coming June. So this much amount will be given to this preferred stockholder. In a coming year, they will announce other numbers of preferred stock. In the same way, in this periodically they will retire or they will get back their certificate and pay the par value to the preferred stock shareholders. Third is conversion option. That is the best option, that certain issues are convertible into a common stock. Maybe it is said that after 15 years, this preferred stock will be converted into a common stock. So this doesn't cost any extra to the organization. At the option of the preferred stockholder. If preferred stockholder wants to convert these shares in a common shares, that the company is ready to convert it after, let's suppose, the given date that have been mentioned by the company. Used most frequently in acquisition of other companies. Transaction is not taxable the shareholder of the acquired firm. In such a cases, let's suppose this is T target, this is A acquirer, and T have both type of asset, common share and preferred share. Now this acquirer will pay to both of these shareholders. In this case, the company A acquirer can give an option to this preferred shareholder to get the common share of this A Limited. This is one of the attractive because it is not taxable at all. Use of preferred stock in financing. The corporate issuer means the company who issue this preferred stock is uses irregularly. It's not regular financing. It is irregular because mostly people do not want to invest in preferred stock because the preferred stock dividend is not tax deductible. Utilities means tax deductible for this corporation, so it is irregular. Interest is tax deductible, so why not to finance your project with the debt rather than preferred stock? So corporation prefer to issue a bond or debt instrument in order to get tax advantage. Utility use more frequently as preferred dividend can be accounted for when setting customer rates. That is basically specifically to the United States. The corporate investor is attracted because of what? Because of interest rate. Preferred stock is generally 70% of the dividend can be excluded from taxes. So maybe these corporate investors invest in preferred stock because maybe for these corporate investors such as mutual fund, pension fund, the preferred stock dividend may be when they are receiving preferred stock dividend, they will pay no taxes at all. Flexibility in paying dividend and infinite maturity similar to perpetual loan are significant advantage to the corporate. This is basically one of the benefit to the corporate issuer, that the dividend the company is not liable to pay a regular dividend. When the company wants, they will declare a dividend, and when they don't want, they will not declare a dividend to these preferred stockholder, and there is no compulsion to pay back these principal amount to these preferred stockholders. So it is that have a very large flexibility, and the corporate issuers sometimes willing to issue these preferred stock because they never face a bankruptcy cost in preferred dividend in case of referendum. The after-tax cost of preferred financing is greater than of long-term debt financing to the corporate issuers. So this is one of the disadvantage to the company who issue this preferred stock, and this is one of the advantage because it is flexibility, do not pay a regular dividend, no infinite maturity, but their cost of capital in this case increases, while in this case the tax advantage on the debt financing is available to corporate issuer rather than on preferred stock. So this is one of the disadvantage to the corporate issuers. Value of call privilege, that is callable bond value is equal to non-callable bond minus call option value. Call option means when the company will call these preferred shares this preferred share, when the company call this preferred share, what will be the value of the preferred stock? So this value is then deducted from this value, we will call a callable value. It is not, it is preferred stock, so the formula is basically like this: non-callable preferred stock value minus call option. The call privilege is available to these preferred stockholders such as Preferred stockholder required a premium for additional risk in the form of higher yield. The greater the volatility of interest, the greater the probability that the firm will call a preferred stock. Thus, the call option is more valuable, all else equal. Valuable to whom? Valuable to the company. Thank you. This was all about today's lecture.